Us now is Bridgewater Associates Co-Chief Investment Officer for Sustainability, Karen Carnial-Tambor. It's great to have you, Karen. We just heard from President Biden, and the focus all day has been on Afghanistan, which there's no direct market link, and the market has a history of sort of looking past these sorts of geopolitical events. But one thing I did read in some of the research notes is it could potentially change the calculus for fiscal policy and hurt or weaken President Biden's agenda with trillions of dollars at stake. And I know you've been writing about that. Does it change your view about what is likely to pass in terms of fiscal stimulus and what that's going to mean for the economy and the markets?
Unlikely. I mean, we're in a place where, as you said, these geopolitical events, while moving to all of us, are not going to have a very direct impact on the economy or markets. And the most important thing for the economy and markets right now is that we're on the cusp of passing what's very likely to be the biggest stimulus package we've ever seen in history outside of wartime and the direct response to COVID-19. And the reason that it's likely to have staying power is it's not a response fiscal stimulus meant to, sort of just offset something cyclical happening in the economy. It's very much structural. It's very much intended to remake the economy and to change its shape and happen over quite a number of years. And the fact that such a big part of the package is bipartisan, both the bill that was focused on competition with China and had things like paying for semiconductors and research and development and science, as well as the infrastructure package that really underlies a lot of what makes the economy productive. And then the part that the Democrats are likely to pass through budget reconciliation, it's more focused on, social and environmental goals. This is a huge, huge impact on the economy and markets over many years.
With all this fiscal support, does that mean the Fed has cover to reduce its monetary support? And what does the net effect do to equity markets?
Absolutely, in our view. I mean, any way you look at it, more or less, the Fed looks well behind the curve. Policy is about as easy relative to conditions as it's ever been in history. Inflation and wages are both the strongest they've been in 40 plus years and rising. So when you have zero interest rates in that kind of environment of inflation and wages, that means that the quote unquote real rate is about as negative as it's ever been in history. And when you listen to companies and what they're saying, it doesn't seem like very short-term transitory. It looks like that wage cost spiral that you really need companies to engage in to get inflation to rise is kind of well underway. And so when you add that up and you start getting the biggest fiscal push you've ever seen into such a booming economy, it makes a lot of sense for the Fed to pull the other direction and be willing to, stop some of the massive amount of gas that they're providing when not only is the economy moving, but we're about to give such a huge fiscal push.
Karen, thanks so much for joining us today. Much appreciated.
Thank you.